Beginning in the late 1920s, America would go through a series of economic changes that would come to be known as the Great Depression. The events of the Great Depression would play out over the 10-year period from 1929 to 1939 and would result in significant economic problems for the United States. Ironically, many of the things that caused the Great Depression were also responsible for the economic boom of the Roaring Twenties. To understand the Great Depression, you need to be able to answer four basic questions about how the stock market and the American economy operate. The first question is, what is the stock market and how does it influence the economy? Second, you need to be able to understand how and why Americans invested in the stock market during the 1920s. Third, you need to look at what caused the stock market to crash and the impact that that had on the nation. And finally, what were the other economic factors and decisions that contributed to the Great Depression after the stock market crashed in 1929? To understand the stock market, you have to understand what is known as the typical business cycle. In any economy, the business cycle refers to the economic pattern that shows the movement up and down between periods of growth and decline. So, for example, beginning over here on the left-hand side of the chart, as a company is created and takes on investors, the value of the company and the value of its stock increases. Over time, as more and more investors invest in that stock and in that company, the value of the stock increases and it becomes more attractive. At some point, that stock and that company will reach a peak in its value and its operations and begin to start a decline. Hopefully, this decline bottoms out before it reaches a recession. However, if it does not, the company may continue its decline, may eventually go bankrupt, and in economic terms, we refer to this as a recession or a depression. After a recession or a depression, as stock values are low and companies are restarted, the economy will eventually improve and move on its way to recovery. Ideally, all of the companies and businesses working in economies will go through this cycle at different times. However, that is not always the case, and when large numbers of businesses or large sectors of a nation's economy go through a decline in value at the same time, it can lead to recessions, depressions, or other economic problems. This is what would happen at the beginning of the Great Depression in 1929. While the business cycle is usually a standard process that repeats itself over and over, there are times where the stock market and a nation's economy will deviate from that standard pattern. These times are what is known as a bull market or a bear market. In a bull market, which is what the United States saw in the 1920s, there is a long-term and consistent rise in stock prices. During a bull market, the value of companies goes up. People tend to purchase more and more stocks, hoping to make money. And in the late 1920s, many experts viewed the American stock market and the bull market that was occurring as something that would continue into the 1930s. On the other side, there's what's known as a bear market. A bear market is the opposite of a bull market, at which point an economy and a stock market goes into a long-term continued decline, which results in a drop in stock prices due to the selling of stocks. In the late 1920s, very few people thought that a bear market was possible in the United States, and this led to a variety of risky stock practices, which helped to set the stock market on the course to its eventual collapse in 1929. During the 1920s, many Americans engaged in risky stock purchasing tactics as a response to the prosperous economy and the bull market that was occurring throughout much of the 20s as America's economy grew. Many Americans began to buy stock on the margin, which means that they were buying stocks on credit or with loans from banks or stockbrokers, and they did not actually have the money to purchase the stocks they were buying. In many cases, private individuals borrowed their money from banks, while in others, stockbrokers would actually take on those loans for the investors that they were working for. The goal of the brokers was that they would take out the loan, purchase the stock, and when the stock was sold at a higher price, the brokers would get back the money that they had borrowed, would be able to pay off their loan, and that they would have made money through the transaction while their customer also made money. The second risky stock purchasing tactic that Americans used during the 1920s was the concept of speculation. Under speculation, brokers and investors would put money into very high risk investments, hoping to make a quick profit. For example, brokers would buy newly created stocks or stocks that were up and coming, as well as stocks in companies who were coming up with new and unique products that they thought Americans would purchase. In these instances, investors would hope to dump large sums of money into these stocks, hoping that they would grow quickly, and then the investors would be able to sell the stock and pull their money out after that quick growth and making a tidy profit. In order for speculation to work, investors had to believe that no matter how much money someone paid for a stock, there would always be another investor who would be willing to buy that stock at a higher price. This is simply not the case, as some companies will ultimately peak in value, as discussed in the previous slide looking at the economic cycle. This combination of buying on the margin and engaging in speculation resulted in many investors losing money on their investments. As more and more investors began to fail in using these risky stock purchasing practices, they began to sell their investments and sell their stock, hoping to get enough money to pay back the loans that they had taken out when buying on margin or speculating. This quick selling of stocks led to what became known as the stock market crash that occurred on October 28th and 29th of 1929. These 2 days are referred to as Black Monday and Black Tuesday as a result of the very rapid and severe decline in the American stock market and economy. Over the 3-day period from October 28th to October 30th, roughly 35% of the American stock market was sold as investors hoped to limit their losses and get enough money out of their stocks to pay back the loans that they had taken out through the process of speculating and buying on the margin. As more and more investors were unable to pay back their loans, they continued to sell more and more stocks, and as you can see in the graph on the right-hand side, the stock market went through a 3-year decline in which it lost over 50% of its value. Some estimates have the stock market declining by up to 75% over that 3-year period. As a result of the quick decline in the stock market on Black Monday and Black Tuesday, America saw the panic of 1929, where more and more investors sold off their stocks as the prices of stocks dropped and the values of companies declined. When people could not make enough money from selling their stocks to pay their brokers or pay the banks that they had borrowed money from, they were forced to sell their property and other valuables or pay off their loans by dipping into the small savings accounts that many Americans had set. As Americans began to run out of money and were forced to pay brokers by selling their valuables, other Americans began to withdraw their money from banks and began to hoard it, making sure that they would have money available when they needed it. As more and more Americans took money out of American banks, it led to a decrease in overall spending, as Americans were concerned about being able to pay back loans, and an overall decline in the money supply and the movement of money throughout the American economy. As the Panic of 1929 began, Andrew Mellon was serving as the Secretary of Treasury for the United States government. Mellon did not view the stock market collapse as a serious problem for the United States and actually told President Hoover that a panic in a stock market crash was not altogether a bad thing for the American economy. Due to his beliefs in laissez-faire economics and capitalism, Mellon believed that this was just part of the natural business cycle and that America would eventually recover and rebound as the stock market went back up. Mellon also believed that many Americans had been living beyond their means due to the purchasing of goods through credit, and that this series of events would actually correct the poor economic decisions made by many Americans. Mellon's failure to see the seriousness of the stock market crash and the impact that it would have on American businesses and on the American economy magnified the problems that were occurring as a result of the stock market crash and the run on banks during the Panic of 1929. One final action that was taken to help lead America to the Great Depression was the passage of the Smoot-Hawley Tariff, which occurred in 1930. This tariff raised taxes on imports coming into the United States. The belief behind the tariff was that by raising taxes on imports, foreign goods would become more expensive than American goods, and Americans would purchase the cheaper American goods, helping to stabilize our economy. While this was a good thought in theory, the passage of the Smoot-Hawley tariff led other countries to enact similar tariffs on American goods that were going to their countries. These higher tariffs led to limited markets and fewer opportunities for American businesses to sell their goods, and reduced the ability of American farmers to ship food overseas. This combination would expand the Great Depression to include many of the other countries around the world and make the situation in the United States even more difficult than it was during late 1929 and early 1930. Looking back on the Great Depression, there are four basic factors that caused the United States and the world to go into a severe economic collapse. The first is the risky stock price practices, where investors were speculating and hoping for get-rich schemes and making risky investments, trying to make a quick buck on the stock market. This, combined with buying on margin and not actually having the money to pay for the stocks people were buying, caused the stock market crash on Black Tuesday, October 29, 1929. The collapse of the stock market magnified a second problem within the economy of America in the late 1920s. The uneven distribution of income and wealth that had been occurring as the American economy grew resulted in many Americans buying goods on credit. Roughly 75% of goods that were purchased during the 1920s were purchased on installment plans, where low-wage workers were buying goods on credit and making monthly payments to pay off the balance that was owed on the goods. When American workers would eventually lose their jobs and businesses began to shut down, this led to workers being unable to pay back the loans they had taken out for buying products on credit. As Americans were unable to continue buying goods due to the loss of jobs and the inability to get credit or maxing out their credit, American industries began to overproduce goods and ended up with a surplus of goods that they could not sell. The surplus of goods required businesses to sell their goods at lower prices than they had originally figured, or resulted in businesses closing factories and laying off workers. By the height of the Great Depression, roughly 25% of the American population would be unemployed and would have lost their jobs. Lastly, the economic factors of the Great Depression were magnified due to the problems in agriculture. Both the Smoot-Hawley Tariff and the Dust Bowl, a 15-year period where there had been a lack of rain and wind erosion on the Great Plains led to some problems for farmers. Farmers who were still successful were overproducing goods and were unable to sell them overseas as a result of the tariff. And many farmers went into debt trying to buy new machineries and trying to keep their farms running during the Dust Bowl. As farm prices dropped and the costs of food declined, farmers began to lose their land and were unable to pay back the loans they had taken to keep their farms running. This combination of four major economic problems is what ultimately came together to cause the Great Depression. America's Great Depression would last for roughly a decade, from 1929 to 1939. During this 10-year period, America would see the largest economic depression of the 20th century. Over 50,000 American businesses would fail and close as a result of the Great Depression. Roughly 23 to 25% of the American workforce would be laid off from their jobs and be unemployed with no income and no way to support their families. Over 9,700 banks would close, and many Americans would lose the money that they thought they had safely placed in these banks. And in total, over $30 billion would be lost through the closing of banks and the failure to protect the money that Americans had put in them, through the losses in the stock market, and through the failure to pay back loans that had been given out by the banks to investors, farmers, and Americans who were buying goods on credit. This economic decline would impact the United States all the way until the late 1930s and early 1940s, as World War II began to break out and America would return to a wartime economy.